it seems likely to me that they know that there's more trouble lurking. Everybody has been waiting for the shoe to drop on commercial real estate, and it's a known problem, and it's big. It hasn't been marked to market. So bottom line here, I'm not saying, head for the bunker in Idaho, it's all about to blow up, and let's not get overly dramatic here. But it just seems like that problem has to be pretty darn significant for the powers that be to try to massage the markets and investors out there and get them ready for some bad news.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 5th through February 12th, 2024, while supplies last. This week we have silver Valcambi or Asahi 100-ounce bars at just $1.39 over spot per ounce. We also feature pre-1933 gold $10 and $20 Liberties at $89 over melt and $139 over melt, respectively. Next, backdated 1-ounce silver maples are at $3.75 over spot with a minimum order of 50. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Lobo Tiggre from the Independent Speculator. I did want to discuss the banking system. It's funny because I remember before the 2008 crisis, Bernanke was saying, everything is fine, and it seems like we're seeing similar speak out of the Fed about the banking system is sound and resilient, and that maybe a couple regional banks will fail, but it's the situation is going to be contained. Your perspective on what we could see going forward here?
Yeah, contained, famous last words, though that's dangerously close to making a prediction on my part. It's interesting to hear the Fed speak now, or not just Fed speak, the powers that be more broadly, because we've got Yellen chiming in as well. And I was really stricken by, of all the things that Powell said in his 60 Minutes interview, the one that really stood out for me, he said not maybe or not, oh, it's fine, everything will be fine, and maybe a few small players. There wasn't no maybe about it. He said certainly, which was really striking for a sitting Fed chair to say. He said certainly some of the smaller and regional banks will close or be merged out of existence. That's a pretty striking statement for the powers that be. And then the next day we get Yellen in Congress saying that, yes, she has some concerns, but it's okay, but it's uncontrolled, but yes, certainly there are some concerns, in the way she goes on. Oh, it's painful to listen to her. Even if I agreed with her and everything, it would be painful to listen to her. But anyway, I don't want to get personal. When you have different aspects of the powers that be saying basically similar things, it makes me think there's a plan there. You can call me a conspiracy theorist. I'm not saying that I know what's going on in the secret halls of Washington, but gee, what a coincidence. So I think it seems likely to me that they know that there's more trouble lurking. Everybody has been waiting for the shoe to drop on commercial real estate, and it's a known problem, and it's big. It hasn't been marked to market. So bottom line here, I'm not saying, head for the bunker in Idaho, it's all about to blow up, and let's not get overly dramatic here. But it just seems like that problem has to be pretty darn significant for the powers that be to try to massage the markets and investors out there and get them ready for some bad news. So interesting times. I'm not promising the next 2008, but it seems to me prudent to be prepared for more trouble in the banking sector. And if I'm right about the U.S. being basically mostly in recession but in denial, and the economic recovery being much more, if you want to call it a recovery, being much more fragile post-COVID lockdowns than is admitted, then something like this has the potential to cause fireworks. Again, that's not a prediction, but that's the beauty of gold, right? It's insurance. You hope not to have to use your insurance policy, but you're sure glad to have it if you ever need it.
It is interesting because we see a lot of good economic data coming out. But I remember we just had Michael Pinto on, and he was saying, if you consider that inflation is being underreported, then GDP is being overreported, real GDP, right?
Yes, it's adjusted for official inflation.
Exactly.
Yeah.
So if we consider what the real economy is, did you want to kind of comment on that, how the data seems to be massaged to make it look like we're not actually in trouble right now?
Well, of course, our audiences, both of ours, they want to hear us stick it to the man. Those evil manipulators, they're lying. And frankly, I'm very sympathetic to that. But I'm always very cautious about drawing a line between what I suspect, what I think, even if I think it's very likely, and what I know. Those things are not the same. But you know what? Whether the data is manipulated or not, or how manipulated it is, I mean, we know that things like hedonic adjustments and so on are, that is a massaging of the information. A qualitative, not quantitative massaging of the information, which is important. But even if we accept the numbers as they are, there's, plenty to poke at in these official numbers. And okay, so GDP is a flawed measure to begin with conceptually, let alone the inflation adjuster. But look at this blowout jobs report that we just had. You haven't asked about that, but this was supposed to, 353,000 jobs. And this time it wasn't all government jobs. And there were even some manufacturing jobs. The economy's doing so great. But you look at the hours worked and they're down. You looked at the government's, not just, anarchist Lobo's, jobs report, but you look at the government's other jobs report from the BLS, and the number of employed people went down in January from December, the so-called household survey. And so, there's plenty of cracks in the armor of this one area that seems strong in the economy. And okay, we've got Wall Street firms beating their projections, but these are projections based on lowered forecasts. And if you look at what else they're saying, the guidance these companies are giving, forward-looking guidance for this year, it's gloomy. By and large, it's gloomy. Unless you happen to be an AI play, artificial intelligence chip maker. Basically, everybody else has got a gloomy outlook, from Apple to FedEx to, you name it in between, large retailers. So the government officials are telling us that everything looks great. The people actually in business, in big business, are giving us gloomy forecasts. So without saying that I know for a fact that one is true and one is false, I'm just saying I'm going to go with the larger number of private sector forecasts here. And I'm going to say things look weaker. And to connect this to our earlier question, if that's a powder keg, waiting for a spark, even if, objectively, the three banks that failed last March, were not that big a deal, you could say. The powers that be threw the kitchen sink and everything at it. The level of response, the Fed making all banks whole on their underwater paper, that was absolutely a crisis level response to just three banks in trouble. So if we see a repeat, things go off the deep end. If the powers that be lose control, there's potential for maybe more excitement than any of us really want. So for prudence, I'm glad to have savings in gold and silver. Yes, I do like silver. Darth Silver does, in fact, stack silver. But I'm also speculating on the stocks. And the beauty of the current setup is that the sentiment is so negative in the space that there are great gold stocks on sale, not just, the crappy wannabes, but, blue chip gold stocks selling relatively or nominally cheap. And I see that as a terrific opportunity going forward.
And I would like to get into that, gold being your favorite trade this year, and also uranium. Those two metals I want to discuss a bit later. I did want to still hone in on the banking issues right now. A lot of people are pointing to the fact that the Bank Term Funding Program, which essentially let banks loan to the Federal Reserve, they would loan the treasuries at par, even though mark to market they were at a much lower value. And the Fed would loan them cash to have extra liquidity. That program is going to be ending. And it seems like that was the program that really saved a lot of these banks and kind of stabilized the system for the time being last year. Do you think the ending of this program will have any negative effect? Will it bring back the banking crisis?
I doubt that, because, don't confuse, dear audience, evil with stupid, or or misguided with stupid, or hopelessly trapped in a job that doesn't let you be honest with the public with stupid. So these guys, I think, in the Eccles building and other marble monstrosities in Washington, D.C., they're not all stupid as much as we want to think that they're stupid, or as much as the things that they say sound stupid. I think some of them are evil. I think some of them are misguided. I think some of them can't say what they really think. They think their job is to steer the ship of state into safe harbor, and telling the truth, which would cause people to panic and sink the ship, doesn't fit that job description. So if they're not all stupid, I don't think they would do that knowing that it was going to sink the ship. So if the Fed, and I've seen commentary on this, like, why would they even give guidance to this? Why not sort of quietly let it happen and then see what the market response was, and then, correct course if necessary? So I think the fact that they announced that they were going to let it sunset, which they did, it runs out in March, and they said we're going to let it lapse. I think that means they see data that they think that they're okay with that. Now, at the same time, so actually that guidance was given some weeks ago, and the guidance we're getting now on commercial real estate, certainly according to Powell, causing some banking distress. That's much more recent. That's the last few days. So maybe they have new data since they said that, and now they can't walk it back. I'm not sure. But the answer to your question is, I don't think they would pull the plug on that knowing it was going to cause a problem. And, given the hundreds of PhDs they have running around looking at these things, they'd have to be pretty stupid to just pull the plug not knowing. I think they think, or at least when they announced it, they thought it would be okay. And now we'll have to see what happens. And by the way, if suddenly the commercial real estate is this big surprise that nobody could have seen that coming, right? Well, maybe that's an excuse to reinstate that emergency program instead of pull the plug on it. We'll see. Or actually, if we want to get a little bit more devious-minded, maybe they made that announcement on purpose to see if the market would react in an exaggerated way. Maybe that was the trial balloon. And there were signs of instability, and so now the commercial real estate scare is walking that back. Who knows? None of us are in that dark, smoke-filled room. We don't know what they're thinking. But I've gone on too long. Short answer is, I don't think they deliberately do things that are obviously stupid. They may spin it however they want, but they had reasons for what they did.
Now, looking forward into the investments that you think will benefit from this crisis going forward, gold is, I know last time I had you on, you said that gold is your favorite asset for 2024. Can you expand on give us an update where you see it headed, and why is it so favorable? Are you so favorable for this year for gold?
Sure, happy to go there. But before we move on from the macro, let me just push back a little bit. The response to this crisis, and I may be snatching your clickbait headline away from you, Elijah, I'm sorry, but I'm not actually predicting a crisis here. Remember, I said I'm not predicting 2008 all over again. That could happen. That could be in the cards this year. Absolutely. But I'm not predicting it. And remember that they did in 2009 kick the can down the road. And more remarkably, in 2020, they kicked the can down the road. And even though Powell and company have done their best to say the Fed put is gone, you're on your own, Mr. Market doesn't believe that. I think there's a real potential here that if things get bad, remember how long bad news has been good news on Wall Street. So instead of seeing a market crash because there's signs of trouble, you could actually see the markets accelerate. You could see I would actually expect, as soon as the trouble is undeniable, I would expect the powers that be to unleash the free money helicopters again, open the easy money floodgates, whatever metaphor you want. So it could be that there is no recession at all, not because of the no landing scenario, but because it's obvious we're going to hit and they pull out the money stops. I think more likely we do hit we hit something bad happens, and then they pull out the money stops. Either way, I would expect the powers that be to really react quickly and with huge amounts of money, like more each time we get unprecedented. I think the next unprecedented will be even bigger than the last one. So it's not a foregone conclusion that the economy or the markets are going down the circular drain, depending on how effective the money bazookas, helicopters, floodgates, etc. are. Sorry. I just want to clarify that because if you say, oh, Lobo Tiggre predicts crash of 2024, that's not the headline I can get behind, though it may happen. All right, so how to play this? Again, bullion is insurance. It's, the financial asset that you can go long with no short. You can hold it in your hand. It is physical wealth with no counterparty risk. For all those reasons, I love that. But that's saving. That's not how I'm not buying gold or silver because I think the prices are going up. I'm buying it in case everything else goes down, and that's my safe haven. That's what a safe haven is. Now, if I'm right in my macro outlook, just think about this. We're going into, at the very least, turbulent times, whether or not there's a crash. And we're going into that not at $1,000 gold or $1,500 gold. We're going into that at $2,000 plus or minus gold. And recessions have always been good for gold. Turbulence is good for gold. Safe haven demand is good for gold. Never mind the geopolitics. We've got two hot wars, either one of which could become World War III. There's not a lot of argument for gold going much lower here. And there's a lot of cases for gold prices or gold dollar exchange ratio, as I like to say, going much higher, in which case the stocks should deliver with gusto. And I mentioned earlier, the stocks are unloved, the sentiment is so bad. Either I'm right or I'm wrong about this. And this is one of those this time is different things. And I'm not saying this time is different. I'm saying if gold goes up and the gold stocks don't, that'll be basically the first time ever. If you get a big breakout in gold and the gold stocks go down or don't go anywhere, that just doesn't happen. So I don't think this time is different. I think what has happened is the recency bias. The last times gold has gone up in a big way, it has not stayed there long. It has hit some new record high and then gone down for years. And I think that's still the expectation, not from you and I or our audience, but from comics traders, LME types, folks on Wall Street. They think that $2,000 is too high for gold. It should have never risen that high. It was just a spike, a fluke, and it'll go back down. It's a pet rock, right? Who would pay $2,000 for a pet rock? So I think that has kept the gold stocks back. And yes, some of the companies have failed to deliver or blown out their balance sheets. There's other issues there too. But I think it's mostly this expectation that instead of the gold stocks coming to catch up with gold, that gold will drop to come down. The gold stocks are a market instrument far broader than futures on the COMEX. And the gold stocks are telling us that Mr. Market thinks gold's going down. I think he's wrong. I think gold's going up. And when he realizes his mistake, I think the gold stocks come screeching higher. So I see a asymmetrical trade here, which I like a lot. But I have to say, Elijah, thank you for mentioning the other yellow metal. When we last spoke, I did say that uranium was my highest conviction trade for 2023, and I felt similarly about gold in 2024. I have to say, we've got new data. The uranium market has changed significantly since you and I last spoke, or perhaps the market hasn't really changed, but the solid data we have on it has. And the game changer there is Kazatomprom. Some wise observers like Justin Hune and others in the uranium space have predicted that Kazatomprom was going to have trouble ramping up production as promised. They were right, but you know how I am. I'm very suspicious about predictions. So, kudos to them for getting that right. But instead of now some expert's prediction, we have the company itself admitting that, sorry, that production increase is almost entirely off the table. And by the way, more telling to me, guidance, I always take guidance with a grain of salt anyway. But more telling to me is, never mind the guidance, they actually produced less uranium in 2023 than 22. Like whatever the guidance, their actual production went down. So that was a real shocker. And this is the world's largest, lowest cost producer, which is clearly struggling to make its current production and saying that our increased production, well, maybe not so much. So those were, millions of pounds that the market was expecting that are now gone. I have to say, just as you and I are speaking, we just had Cameco, the world's other largest, lowest cost producer out there, basically delivering kind of the opposite. A great year. They basically doubled their net income and their cash position. They were able to ramp up significantly, and they're still guiding for their ramp ups. Both of them were ramping up, and Cameco is saying, game on. We still expect to deliver. Whether they can or they can't, we don't know. I just said I always take guidance with a grain of salt. But here's the thing. Cameco is saying that we're game on. We're still standing by our guidance. We think we're going to be able to ramp up. That was already in the market. This isn't new. They're not adding new increased production or saying we're going to blow away our prior expectations. They're just saying, yeah, we're still on. We're still headed up. Whereas Kazatomprom was a change. They took away something from the market. So net, I see the balance of supply and demand much more in favor of higher uranium prices this year. This is the difference from when you and I spoke last time. So I have to say, it's not the first time I've ever said it. I think the last time I called it the year of the two yellow metals was 2019, which, it took a while to get going, but it worked out. This year, I have to say, it's no longer just gold or gold stocks for speculation. Gold is always there. I always want to accumulate gold. If I have extra savings, I want to lock away long term, I'm buying gold. But speculating on gold stocks, I'm very bullish this year. And uranium, I really think at this point, looking at the new balance of supply and demand, it would take a Chernobyl level event to derail the uranium thesis. And the green mantra that it's now got, you got 28 countries saying they want to triple their nuclear power generation by whatever years from now. I mean, this is a big, big deal in a supply constrained market. So I really do think that it would take something on that order to derail this thesis. And previously I'd been thinking, okay, well, we had the low hanging fruit. I'm going on at length here, sorry, but I'm almost done. We had the low-hanging fruit of, Cameco and Kazatomprom ramping up, and you had low-cost mothballed production and or new projects. High prices cure high prices. I was concerned that this year, 2024, the low-hanging fruit would temporarily, this year, cure high prices. We're already way above the incentive price, or what we thought was the incentive price. So that was my caution for uranium this year. And what I'm saying now is with Kazatomprom yanking those pounds off the market, I'm no longer that cautious. I'm actually quite bullish on both yellow metals this year. One last thing, since uranium is not a monetary metal, it's not a safe haven asset, but since it's fairly recession resistant, right? Uranium is baseload power. You want your nuclear power plants to run 24/7, 365. That's the beauty of them. I see this as a kind of win-win portfolio or a self-hedged portfolio, because if I'm wrong about the gold-dollar ratio breaking out and gold stocks going up, my uranium stocks should do great in that world, in that happy, happy, joy world. If I'm right, I think both do well. If I'm right in my macro, I think both yellow metals do well. And if it turns out all those uranium bulls are overly optimistic and there's more supply that we thought that comes to the market in 2024 isn't such a great year for uranium, well, I still think my gold stocks will do well. So you see the balance I've got here going? I think this is a good year to split your portfolio or your speculative portfolio between the two yellow metals.
One last topic I did want to touch on is about the precious metals, gold and silver. It seems like the mainstream is starting to catch on to the high prices we're seeing in gold, above 2,000. And also there are forecasts of silver making, new highs this year. The mainstream's reporting that it could be very, this was a CNBC article saying that 2024 could be a very good year for silver. Before just like us jumping on that bandwagon, it might be good to, step back and say, have the precious metals gone too mainstream? Because obviously that's a sign of a bubble. So your perspective on that.
That's the pushback. I tweeted that CNBC article about silver potentially having a breakout and outperforming gold. And there's nothing new there. I mean, silver bulls, we all know that silver tends to lag gold in a bull market and then more than catch up in the end. It's more volatile, underperforms at first, more than catches up at the end. That used to be an unbroken track record. And, silver bulls get mad at me when I point this out, but, the fact is that this did not happen in the 2020 breakout. And that's concerning because it's the most recent, if it was if that silver more than catching up was true 9 out of 10 times, well, heck, 90%, that's a great ratio. It's a good bet. But the fact that it's the last one that it didn't suggests that, well, if the market has changed, it makes it more questionable than 90% that the next one time it will do so as well. But I don't see silver getting left behind. We have seen, in the face of geopolitical concerns, which would not affect silver as an industrial metal, but would and did affect it as a monetary metal, we've seen silver track gold, particularly since the Gaza conflict. So that's very reassuring for silver bulls that, yes, silver is money, has been for thousands of years. It's still regarded that way, still a monetary metal. Which brings me to answer your question. When I posted that tweet about silver having a good year on CNBC, the number of people who just knee-jerk reaction, oh, sell it now, sell it all, that's a top signal, oh no, get out now, it's going to $10 or whatever. I get it. I understand. It's funny. I think a lot of the people who post these memes and tweets, it's tongue-in-cheek. I doubt any silver bulls saw that article and went to the coin shop and dumped all their stacks of silver coins. I don't think anybody does that. But I understand the sentiment. And there's a well-known chart. It's not mine. I don't have it handy, but there's sort of the various phases of the market, the stealth phase, the wall of worry phase, and so on, the blow off top and cycles down again. And in that wall of worry phase, there's some differentiation between like the media attention phase and the hype phase and so on. Looking at where we're at, I think objectively, it's easy to make a case that we're nowhere near that blow off top. So all these knee-jerk reactions, oh, it's going mainstream, sell, sell. My favorite contrary to that is, no, Kramer hasn't hit the buy button on silver yet. When Kramer hits buy on silver, that's when I'll know it's the top. But you know what? None of these things are sure guidelines. I'm a fundamentalist, and I'm not a TA, and I'm looking at the market, and I just don't think we're anywhere near the top. And the fact that some mainstream media is starting to notice, I think that's just it. It's the beginning of that media phase. So no, I don't see the mainstream coverage we're starting to see as contrary. Actually, I see it as kind of exciting, if I'm right, and that's a beginning. Particularly if I'm right about what I said before, that to the degree that anybody out there in the larger universe, not gold bugs, the Wall Street types, the Chicago types, the London types, right? To the degree that they pay attention to gold at all, I think they've been expecting it to fall down. It went to record highs, at least nominally. And the recency bias and the track record, the history, frankly, is that when you hit an all-time high in the gold-dollar exchange ratio, it goes down afterwards. And instead, we've basically gone sideways for 3+ years. At some point, you'd think they'd start changing their tune and saying, wow, this is still there. And I do see that. I see mainstream analysts on, even Yahoo Finance, where all they want to talk about is Chipotle, Tesla, and NVIDIA, or Bloomberg, or these mainstream outlets. I see some of these guys saying, yeah, we're doing this, and we're going risk on here, and we've got some, value sector, blah, 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 and we've got some gold too. And that really wasn't there a few years ago. And they're not saying, oh, go all in. They're not gold bugs. They're not saying, oh, everybody go buying gold. Yeah, we just have a bit of a hedge on there on gold. I think that's really striking. I think you've spoken with our friend Rick Rule, and one of his favorite things is that historically, the overall global allocation to gold in investment portfolios over the last 50 years is 2%. And then it's currently less than 0.5%. So if it reverted to the mean, no all-time panic highs of gold holdings, but just reverted to the mean of 2%, that would be a 4x investment demand increase for gold. Now, the world is different. Maybe with Bitcoin, gold never goes back to its previous mean. But you know what? If it just goes to 1%, that still doubles your investment demand for gold, which is very important in the gold market. It's not like silver. It doesn't get used industrially that much. There are industrial uses for gold. It's not just a pet rock. But whether investors are hoarding or dishoarding gold has a much bigger impact on the gold market than it does on, copper, silver, other things, right? So this is important. If the media are starting to cotton on that investment professionals the larger universe, not just us gold bugs, are getting the feeling that a bit of a hedge in gold is maybe not such a bad idea, that actually is another game changer. It'll be interesting to see how that plays out.
And if our viewers are interested in continuing to track this with you, independentspeculator.com, can you share with our viewers what they'll find there?
Sure. There's a lot of free content on there, and the easiest thing to do is to sign up for our free weekly newsletter. It's called the Speculator's Digest. And I can't promise to get everything right, but I do promise that if you do sign up, we will not flood you with a daily flood of advertisements. I hate that spam. So, check it out, see if you like my thinking, and maybe you'll hire me to be your due diligence guide through my paid services, but if not, you're still welcome aboard.
Fantastic. Lobo, once again, thank you so much for your time, and God bless.
Thank you, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 5th through February 12th, 2024, while supplies last. This week we have silver Valcambi or Asahi 100-ounce bars at just $1.39 over spot per ounce. We also feature pre-1933 gold $10 and $20 Liberties at $89 over melt and $139 over melt, respectively. Next, backdated 1-ounce silver maples are at $3.75 over spot with a minimum order of 50. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.